hey,
magnificent,
hey,
magnificent,
hey,
magnificent,
hey,
magnificent,
hey,
magnificent,
hey,
magnificent,
hey. In the last episode, we got a mental map of the stock market. The next step is understanding how that system mechanically produces prices in real time. The price you see on a chart reflects the most recent trade that printed on a lit exchange. That's price discovery. It's that simple. What complicates that picture is that a large portion of trading doesn't happen on those exchanges because a lot of it can be contained. Many trades execute off-exchange through internalization and dark pools. Institutional orders use off-exchange venues to accumulate or distribute exposure without signaling intent, and retail orders are often internalized because they're small, predictable, and easy to hedge. These trades still happen at prices derived from the lit market, but they don't update those prices directly. As a result, significant trading activity can take place without any immediate change in share price. As long as buy and sell flow roughly net out, market makers can absorb that activity internally. Inventory stays within risk limits. Volatility remains manageable. Hedges remain effective. In that state, there can be high off-exchange volume and the public price can remain anchored for long periods. Price only responds when off-exchange flow can't be absorbed, when discretion stops being the cheapest way to manage risk, when internalized flow becomes persistently one-sided, when volatility rises, when hedging becomes more expensive, or when correlations break down, inventory can no longer be managed internally. At that point, risk must be resolved publicly. And what looks like a sudden move on no news is often the release of pressure that had been building invisibly until the system couldn't contain it anymore. Those thresholds are monitored continuously by automated risk systems. When a limit is breached, hedging is triggered immediately. Offset trades hit lit exchanges or correlated markets. Quotes are repriced or withdrawn. Displayed liquidity is consumed or repositioned. That's all it takes. Time and pressure. The system you've been looking at is exceptionally good at containing noise. It can internalize flow, net exposure, hedge correlations, and delay visible pricing for long stretches of time. But that containment rests on assumptions, and when those assumptions break, repricing becomes unavoidable. Some pressure comes from outside the market entirely. Geopolitical shocks, sanctions, trade disruptions, energy constraints, sovereign stress are all events that don't arrive as orderly flow. They break correlations that risk models depend on. Hedges that worked yesterday stopped working today. Volatility rises because uncertainty becomes unpriceable. When correlations fracture, internal containment fails quickly and risk is pushed back into public markets. Other pressure comes from flows that aren't discretionary. Index rebalances, ETF creations and redemptions, mandate changes, regulatory shifts, and capital requirement adjustments force participation. These flows happen because they must, and they don't wait for liquidity. When enough forced flow aligns, the system is compelled to reprice regardless of narrative. Time itself applies pressure. Risk that can be contained temporarily often has an expiration date. Options expire, futures roll, balance sheets reset, reporting periods end. What was acceptable yesterday can become unacceptable simply because the calendar advanced. Containment fails because obligations mature. Repricing doesn't always have to begin with forced buying or selling. Sometimes long periods of low volume when liquidity steps away can lead to price discovery because absorption capacity shrinks and the system isn't willing or able to absorb even modest risk anymore. None of this requires coordination. No one has to decide price should move. Each constraint tightens independently, and when enough of them bind at once, the system has no choice but to express risk publicly. That's why price discovery is a release. The pressure was there long before the move, and the movement that you see on the chart shows when containment finally failed. It also explains why stocks can trade far from fundamental estimates for extended periods. Deep value stocks exist because price only moves when liquidity conditions change. If there is no sustained new demand, no forced repositioning, and no structural pressure to rebalance exposure, price can remain anchored. The system is not obligated to converge to intrinsic value. It responds to flows, constraints, and incentives. Repricing occurs when those inputs change, not when valuation models update. The key point to all of this is off-exchange trading doesn't try to avoid price discovery forever. It's an attempt to control when it happens. With this perspective of the market, the system can feel hopeless for a retail investor. Prices move for reasons you can't see in real time, activity can remain invisible for long stretches, and the participants driving short-term price discovery operate on algorithmic speed, scale, and constraints that retail can't match. Competing there is a losing game. Where retail does have an edge is in its lack of constraints. Retail isn't forced to manage inventory, hedge continuously, meet mandates, or respond to short-term pressure. Retail investors can choose their time horizon horizon, sizing, and timing. That flexibility allows retail to position early, remain patient through periods of price inertia, and wait for structural pressures that eventually force repricing. In a market driven by constraints, optionality and time are the advantage. Be deliberate. Like, subscribe, follow at The Magnificent on Instagram and X, and let's keep the education going every Sunday at 11 a.m. Central.